how does a bet on sugar water, of all things, unlock the secrets of one of the world's greatest investors? Well, that's exactly what we're going to do today. We're diving deep into Warren Buffett's massive bet on Coca-Cola to see what it can teach us.
This quote just perfectly captures the feeling in the air. See, this wasn't some big, noisy market crash where everyone panics at once. No, this was something quieter, sneakier. The kind of market that looks totally fine on the surface, but underneath there's this creeping sense of dread. And that is the hardest time to make a big move. So you really got to put yourself back in that moment. It's 1988. The big crash of '87 is still a really fresh, painful memory for everyone on Wall Street. Nobody was looking to swing for the fences. It was all about just not losing money. The whole market was playing defense. And then, right in the middle of all that fear and caution, what does Warren Buffett do? The exact opposite. He and Berkshire Hathaway don't just, test the waters. They go all in. We're talking over $1 billion, a massive chunk of their company poured into Coca-Cola. So you have to ask, what on earth did he see that nobody else did? Why would you bet the farm on a soda company when every other smart person was heading for the hills? Well, the answer is pretty amazing. It all comes down to 3 simple lessons he learned. Not in some fancy boardroom, but when he was just a kid. All right, lesson 1. And this is the bedrock of everything Buffett does. And it started, believe it or not, with a little side hustle he had as a kid. It's all about one simple but profound idea: the difference between price and value. And here it is, his most famous quote on the subject: "Price is what you pay, value is what you get." Now, he got this idea from his mentor, the great Benjamin Graham, and it sounds so simple, right? But really, truly getting it, that's the master key that unlocks his entire way of thinking. Okay, so let's break that down. Think of price as the market's mood ring. It's fickle. It changes based on fear or greed or whatever the latest news headline is. But value is different. That's the real fundamental worth of a business, what it can actually earn over time. And the crazy thing is, Buffett figured this out super, super early. And you want to know how early? Get this. When he was just 6 years old, he'd go to the store and he'd buy a 6-pack of Coke for 25 cents. That's the price. Then he'd go door to door and sell each individual bottle for 5 cents. That's the value to someone who's thirsty. He made a 5-cent profit on every pack, exploiting that gap between price and value before he probably even knew what those words really meant. Incredible. Okay, so that's the first pillar, understanding price versus value. The second big lesson, this is the one that connects today to tomorrow. It's where patience literally turns into a financial superpower. It's pretty wild how a single book can just completely change your life. For young Warren Buffett, reading this book, 1,000 Ways to Make $1,000, it wasn't just about making money. It was like a light bulb went off in his head. It was a total epiphany about how money grows on its own. It fundamentally changed how he saw time itself. So the book gave this really simple example. It started with $1,000. Now, that's a nice chunk of change, for sure, but it's not going to change your life. The magic wasn't in the $1,000. It was all about what happened to it over time. And this was the rule he zeroed in on. You take that money, you let it compound at 10% interest for 25 years. See, this isn't some get-rich-quick scheme. It's a get-rich-slow formula. You earn a decent return, and then you just wait. The superpower wasn't about being the smartest guy in the room. It was about being the most patient. And what's the result? That $1,000, it blows up to almost $11,000. That, right there, is the magic of compounding. And for young Warren, that discovery changed everything. Time was no longer just ticking away. It was his single greatest asset. So, let's recap. You know how to spot the difference between price and value. You understand the incredible power of time and compounding. But what about risk? How do you protect yourself when things go wrong? Well, that brings us to the final crucial piece of the puzzle: learning to play defense. Buffett calls this first line of defense an economic moat, and it's exactly what it sounds like. Imagine a medieval castle with a huge moat around it. That's what he looks for in a business: a durable, competitive advantage, so powerful that it's almost impossible for competitors to attack. It's not about winning for a few months. It's about being untouchable for decades. And when Buffett looked at Coca-Cola, he saw a fortress. It had 2 of the biggest, baddest moats on the planet.
First, you've got the brand itself. It's more than a logo, it's a piece of global culture. And second, this distribution system that took 100 years to build. I mean, sure, you could invent a new soda tomorrow, but could you get it into every corner store on Earth? No way. That system makes them practically invincible. Okay, so you have the moat, but there's another layer of defense he uses called the margin of safety. And it's a really simple, humble idea. You figure out what a company is really worth, its intrinsic value, and then you insist on buying it for a lot less. That gap is your margin of safety. It's your built-in cushion for when you inevitably make a mistake. Because, let's be honest, everyone makes mistakes. And Buffett has the perfect analogy for this. He says it's like building a bridge. If you know you need to drive 10,000-pound trucks over it, you don't build a bridge that can hold exactly 10,000 pounds. No, you build one that can hold 30,000 pounds. That way, if you miscalculated something or there's a surprise storm, you're still safe. It's the exact same principle in investing. You leave yourself a huge buffer. And this all goes back to another lesson from his childhood. He learned early on that it's dangerous to just be an echo, to blindly follow what everyone else is doing. So back in 1988, when Wall Street was playing this one single, fearful tune, Buffett refused to be an echo. He'd done his own homework, he had his huge margin of safety, and he was ready to play his own music. So, okay, let's put all the pieces together. 1. Find the true value. 2. Let time and compounding do their magic. And 3. Protect it all with a giant moat at a margin of safety. When you combine those three things, you get to Buffett's holy grail, what he calls owning the inevitable. So, what did that look like with Coca-Cola? This is the part that Wall Street just completely whiffed on. They were all chasing the next big thing, the exciting new growth stock. But Buffett wasn't looking for excitement. He saw that Coca-Cola was something else entirely. It was a durable, predictable, inevitable machine that just printed cash from sugar water. It was so deeply wired into human behavior around the globe that its success was practically a foregone conclusion. And wow, just look at the results. That initial investment of $1.3 billion, it's now worth tens of billions. But here's the kicker, the part people often miss. Look at that third bar. That's the dividends. That's the cash that Coca-Cola has paid Berkshire Hathaway over the years just for owning the stock. They've collected billions upon billions without ever having to sell a single share. The machine just keeps sending them checks. And that right there, that's the secret sauce. While everyone else was frantically trading, trying to time the market, Buffett did something much simpler. He just owned. He bought a wonderful business at a fair price and had the discipline to sit back and let that incredible compounding machine do its thing. The genius wasn't just in the brilliant purchase, it was in the decades of patient holding. So, what does this all mean for us? Well, it leaves us with a really powerful question to ask ourselves. We live in a world that is obsessed with the new, the next, the disruptive. But maybe, just maybe, the greatest opportunities aren't the flashy ones. Maybe they're hiding in plain sight, looking a little bit boring, a little bit predictable, and ultimately, absolutely inevitable.